Good afternoon, and thank you very much for your attendance at this presentation of Perseus Mining. At the Denver Gold Forum 12 months ago, I started my presentation by observing that in the 12 months leading up to that forum, Perseus had confirmed our clear vision on where we wanted to take the company and developed a strategy for doing so. We had established a track record at that stage of 6 quarters of delivering on promises in terms of production, costs and project delivery. In other words, doing what we say we're going to do. We'd also established a solid platform for growth and continuous improvement in terms of our physical, human, financial assets, as well as our social licence. Now, I noted at that time that despite those achievements, our good work had not been fully converted into share price appreciation, but I suggested that this couldn't have been too far away. So history has shown that that was not a bad call. And as a result, it's with some pleasure today that I present to you Perseus's best performed gold producer in West Africa in the last 12 months. And in fact, in the 12 months that it has passed, we've continued to perform very strongly as a business, meeting guidance consistently, strengthening the balance sheet and delivering on key development milestones. And our share price has risen accordingly. So about 104% in the year, 70% which has been delivered in this calendar year. Now, a casual observer of the stock market would attribute our relatively strong performance to an upward movement in the gold price. And while this is certainly a relevant factor, it's far from the full story. And in the next 20 minutes or so, I'll share with you the reasons why Perseus has performed so strongly and why we expect our underlying operational performance to continue to improve and in doing so continue to enhance the value of our company going forward. So first up, what I'll do is give you a quick snapshot of the company for those of you who are less familiar with the story. I'll then briefly outline our corporate objective and strategy and highlight the achievements that have been delivered through the implementation of that strategy. And then I'll talk to each of our two operations, the ADK and the Singaree gold mine, and our next gold mine, Yoyoing, which is currently being built. And in the process, I'll highlight the growth potential that the company has through organic growth, exploration and optimisation associated with each of those assets. And finally, I'll sum up and hope you leave you with a message that indeed Perseus is a very compelling investment opportunity. But first up, a few cautionary statements. And let's have a look at the overall picture of the company. So Perseus is an Australian company, Australian-based company, but our business is focused on West Africa, where we explore, develop and produce. As I said, we have 2 operating mines, multiple jurisdictions. One mine is in Ghana, in ADK Mine, and the other mine is in Côte d'Ivoire, that's the Singaree mine. And we're currently in the process of developing our 3rd mine, Yoyoing, which is also in Côte d'Ivoire. Now, the Yoyoing should be online by the end of next year, end of 2020, at which time we'll be producing about 500,000 ounces of gold a year at a cost of a little over $800 an ounce all in. So developing a fairly healthy production pipeline at a relatively fine cost. Over the last couple of years, we've worked hard at cleaning our balance sheet and developing some capacity there. We've got strong cash flows coming forward to fund growth. And very importantly, we've got a team of people both at operational, management and board level that can actually implement and deliver outcomes. And fundamentally important to all of this is that we have a very strong social licence to operate in each of the countries where we're active. Now, just looking at our corporate objectives and the like, we see our role as being one of consistently producing benefits for all of our stakeholders. And to do that, we're aiming to produce around 500,000 ounces per annum at a cash margin of not less than $400 an ounce. In other words, generating around $200 million of free cash flow, which can then be used to provide benefits to all of those who have an interest in what we're doing. And in terms of the specific tactics that we have employed to date, it'll come to no surprise to see the sorts of things that are listed on that slide. What we've been able to achieve through the implementation of that strategy is a steadily improving performance. So we're getting consistency in the ounces that we're producing, and we have a slowly dipping cost curve and heading down towards the $800 an ounce. You can see there's 10 quarters recorded here, and I'm very pleased to say that our 11th quarter, which will be released at the end of September, is in line with what we've been doing of late. In fact, if anything, it'll be a slight improvement with a couple of weeks to run on the quarter. Looking further afield, our guidance for the full year is in 260 to 300,000 ounces at a cost of 800 to 975, and as every prudent miner does, we've given ourselves a fair bit of wriggle room in that guidance, having learnt earlier in our life what it means to miss. But where we sit right now, we're very well positioned. We're on track to deliver in the upper portion of the half-year guidance in terms of production, and towards the bottom end of the lower range of costs. As I said, we're substantially improving our financial position as we go, and at the end of June we had roughly 120 million of cash and bullion on hand, and net debt of $31.5 million, giving us around 88 million of net cash. We also at that time had an undrawn line of credit, which we have subsequently drawn a small portion of, and we had very strong future cash flows. I'm very pleased to say that as of today, the net cash position has not moved terribly much, even though since the end of the year we've invested roughly $23 million in the development of our third mine, much of that cash coming directly from the operations at ADK and Singaree. 2019 was a good year for us. We improved our production, we brought our costs down, we generated a good deal of cash, and we strengthened the balance sheet. But very importantly, we also made some significant improvements at our operations. So we brought the AOR Mine up to the starting gate, having got licensing and funding. We implemented a number of very material changes at the ADK Mine, which turned it from a mine that was a perennial struggler to one that is now generating consistent cash margins and generating healthy cash flows, as of course the Singaree mine, which we brought into production, and that's outperformed all expectations from day one. What we've also done is demonstrated some very significant underground potential at our Yoyoing Mine in Côte d'Ivoire, which gives us a lot of optimism for the future and in our ability to sustain attractive long-term performance. Now, this chart you can see maps out what we see the future for the company, and in terms of how we get from where we are today, producing around the 300,000 ounce to the 500,000 ounces, it requires us to continue to implement our operating strategy, and I think the fact that we can now point to 10 successive quarters of good consistent performance, 11 shortly, underlines the point that as operators we're doing quite well. The other aspect of that graph there is the development risk around building our next mine, and I think that we've gone a long way in recent times to mitigating the risk. The team of people who are building this one with us is the same group of people, contractors and our own guys, who delivered the Singaree project ahead of time and on budget, and we've got every confidence they'll do the same thing again. In terms of what happens beyond 2022, we can sustain that level of production fairly comfortably, and we've got a number of initiatives on the table at the moment that we can deploy, representing internal or organic growth, which will continue us along this 500,000 ounce production level. Now, coming to the two mines, as I said, we have one in Ghana, one in Côte d'Ivoire. The ADK Mine was the first of our operations, starting off in 2012. It's a large-scale mining operation. We have 6 pits open. We only mine from 1 or 2 at any particular time, and we've produced about 1.5 million ounces over the life of the project to date. It's been a challenge for us to mine this set of ore bodies, but we have updated our life of mine plan recently, as of 1st of January this year, and we've changed the entire strategy in the mine. Just to put it in very quick perspective, I guess when we started this mine, which was in the throes of the last bull market, our aim was to mine as much material as we could, as quickly as we could, and stream the high-grade material and process the lower-grade material later. Of course, what was associated with this was a very heavy investment in stockpiles, in inventory, and of course that goes to the all-in site costs, and as the gold price fell, that put a lot of pressure on our cash flows. What we've done more recently is we've decided to drop the mining rate, and in doing that we've slightly dropped the production line and revenue line, but very importantly, we've decreased the cost line even further. So in effect, we've increased the margin from this mine, which is exactly what we intend to be doing going forward. Now, at this stage, we have about five and a bit years of mine life left, but we are currently studying a couple of alternatives in terms of optimisation of existing resources, reserves, and the development of the underground deposit. And if successful, then that should deliver a very material extension to the mine life. And we'll be reporting this to the market in full when the detailed plans have been completed later this year. The Singaree mine, the newest mine we have, of course, is a very different proposition. It's higher grade, low cost, very successful development. We've produced, reasonable, right on target as far as our production is concerned, and by the end of this year we will have fully paid off the initial capital cost of $106 million. The problem with the Singaree mine, it's a terrific mine, is that it's got a relatively short life. Although, having said that, we've recently had some exploration success very close to the mine, and we're currently doing resource calculations as we speak, with the expectation that we'll be able to extend the life a little from where we are. Now, the third property which is on the books now is the AOR Mine, which we acquired in 2016. This is a very, very robust project as it stands today as an open pit operation, producing on average of 215,000 ounces at $734 an ounce for the first 5 years and tailing away. It's been fully funded, so the capital cost of $265 million is in place and ready to go. But we have a very prospective land package around this mine, and we believe that an underground scoping study has demonstrated some terrific potential for a very long life underground mine. We received permitting for this in late last financial year, so in May. We fully assembled the financing shortly thereafter. We took a decision at the board to move ahead, and we've been going ahead strongly ever since then. So site works have been going since June. We've completed the clearing of the plant site, and we're starting on the tailings dam. Our earth moving contractor and building contractor have assembled on site and are fully mobilised, and probably in about a week's time the pouring of foundations for the plant will start occurring. We're about 55% through procurement and fabrication, and we're well and truly on track at this present time for the stretch target of first gold in December 2020. We spent about $23 million to date, but very importantly, we've locked in contracts around 50% of the capital cost. So over $130 million of that $265 is locked away in fixed price contracts, and so the risk of cost overruns is somewhat diminished, and is diminishing every day as we go further down that line. And we're in a position where we can largely, even though we have the $150 million debt facility, we can largely finance this development from internal cash. So as we go forward, we'll be fairly prudent around how we get the mix of debt and cash into the funding mix. Now, I've mentioned the underground opportunity here a couple of times, and this is something that's got us really quite excited. As you can see from these cross sections, there's a structure that goes through the footwall of the CMA pit that's about 5 metres wide and grades 5 grams a tonne. We noticed that, and we noticed that there was an amount of drilling outside of the pit shell that we could potentially put an underground resource around. We've come out with an initial resource of about 600,000 ounces grading at 6 grams a tonne, and clearly this is pointing to the fact that with extensions we could have a very material underground mining operation. So one of the things we'll be doing this year is doing some deep diamond drilling to try and peg the structure, and then performing 3D seismic over the land to give us a better definition of that structure, that we can then use that information to target the drilling and firm this up as an opportunity to materially enhance the life of this particular mine. Now, in terms of other greenfields, other organic growth activities, we've got a reasonable holding of land in Côte d'Ivoire and in Ghana. We've got some very exciting targets in close to the infrastructure that we believe we can convert into resources and reserves in coming periods. And of course, there's also stranded assets around each of the mining situations with which we believe that we should be able to negotiate to acquire and bring them into the mine plan in due course. Certainly, Singaree has us quite interested at the moment. I mentioned some possible resource additions. There are two in particular called Airstrip and Zanakan, and you can see from that slide that we've got some reasonable grade coming off those things. We are in the process, as we speak, of defining the resources at each of those areas and hopefully have that in the mine plan by the end of the year. So we're moving along very strongly at Singaree, and that's starting to look quite encouraging. As for Yoyoing, most of the drilling that's occurred on the site today has been around the existing pit, but there is so much mineralisation on these tenements that I think that it'll keep us very busy for many years to come, and we have every confidence that this mine will turn into a very long life mining operation and form a cornerstone of our business going forward. So if we look at the growth profile, as I said, it is quite strong. This is based on JORC compliant reserves. This does not require any exploration success or acquisitions of anything of that nature. We believe that through some judicious exploration on our tenements and optimisation of existing reserves, we can maintain this sort of production profile and cost profile well into the future. And I think that if you look at the cash flow that's coming through, you look at all of the statistics around Perseus and use that as a basis for screening against our peers, you'll see that while our share price has appreciated in recent times, there's still quite a long way to go before we're being marked on a comparable basis to the peer group. So certainly, the Perseus mining story has been one that has evolved over time. This is a major turnaround situation. We are generating outstanding results at the present time, and we have every confidence that that's going to continue long into the future. And that on that basis, our ability to continue to create value for shareholders seems to be in reasonably good stead right now, and we're looking forward to delivering that in periods to come. Thank you very much.
We do have time for a couple of questions. Any questions in the audience? One from me, Jeff. Just in terms of the profile to add the third asset in, what do you think will get the share price up the most? Do you think it's just the delivery of the asset? Do you think it's getting above? Is there a critical level of 500,000 ounces that you think you need for a re-rating? Is it expanding the margins? Is it all of the above, or what's the order?
Chris, I think you as the analyst might be able to answer that question more authoritatively than me, but let me give it a shot in any event. Look, I don't think there's any substitute for performance, frankly, and that's something that we as a business are very much focused on over time. We can control costs, we can control production, we can't control pricing, although we can manage that to a degree with judicious hedging. But that's what we focus on. We focus on performance, on doing what we say we're going to do, and delivering the outcomes that we've promised the market. And I think that we have every faith that if we continue to do that, then we'll screen extremely well, and market recognition will follow.
Great. Okay. Thanks very much. Thanks.
Thank you.